Thank you, Gary, for covering this really important point and a great introduction to our sessions today. Our first panel is on innovation and deal structuring. For those who just joined us, I'm Elena Ray, and I'm a partner in Rudnick's litigation funding team. I also lead the industry initiative on preparation of model documentation for the litigation funding market. Part of what we do at Rudnick is also connecting funders and sources of capitals to disputes and investment opportunities in the litigation funding space. So we really focus on litigation funding as an asset class and spend a lot of time thinking and structuring innovative ways of investing in this space. We have a great panel here today. And for those of you who don't know Adrian, Rob, and Nick Bacon, I'll let them introduce themselves.
So I'm Nick Bacon, Queen's Counsel. Been spending a lot of time, large part of my career in this world. Many of you I recognise, some I don't. Head of Chambers at 4 New Square.
I'm Adrian Chopin. I'm a Managing Director of Benchwalk Advisors, a global litigation funder with about $1 billion of assets under management.
I'm Robert Hanna. I'm one of the co-founders of Augusta, a litigation funder with just under $1 billion under management.
Thank you. So first point I wanted to cover today and discuss is industry trends. We have seen the litigation funding space really expanding in the past few years, with many new funders coming and other players coming into the market, which in turn led to a greater variety of claims being funded. So Adrian, could you give us an overview of how, in your opinion, funding has developed over the past few years and what major trends you're seeing in the market at the moment?
Yeah, thanks, Elena. So I guess among the three of us, I'm the least seasoned in the industry. But so I've been in the industry about 6 years, so you guys have been significantly longer. But weirdly, in such a young industry, 6 years makes you a bit of a dinosaur in this industry. Even when I came into the industry, we were essentially a village with kind of 2 or 3 restaurants offering one thing on the menu. In that last 6-year period, there have been enormous and positive changes in the industry. Yes, there's been a huge amount of money entered into the industry, and that trend continues. That is, I think, unambiguously positive. I think we've seen some spread compression, prices have come down. You no longer get some of the extremely flabby pricing you saw in the early days, and if you do, you can shop that around. We've also seen a huge number of competitors enter the market, and that not all of them survive, and some of the original players who were there 6 years ago no longer exist. But the entry of those competitors, they're no longer all doing the same thing. So we're no longer a sort of village with 2 or 3 restaurants. We're probably like a medium-sized town with 10 to 15 restaurants and a whole load of little ones. But more interesting than the number of players is the variety of products on offer. And that's simply a function of the fact that when you get a lot of smart, motivated entrepreneurial people entering an industry, you begin to see the development of new ideas, and that there's a whole range of different products, many of which we're talking about in this session and other sessions. But just as a general trend, there's been a huge amount of innovation, and there's also begun to be some specialization among funders. You see some funders. I think it's talked about in one of the panels later. At least a couple of funders have set up a sort of ESG arm, a not-for-profit funding arm. You've seen some funders specialise in group actions. You've seen funders geographically focused, sector focused. So there's sort of a great deal of innovation, and it's on the whole very beneficial for the industry. It's also beneficial, I think, for the legal market, and I think perhaps the clearest demonstration is the UK regime for opt-out claims in the CAT, which essentially couldn't exist without funding and ATE insurance, and the whole regime has been designed with that in mind. So perhaps not surprisingly, I think it's been a hugely positive experience for the industry, but also for the legal profession.
Yes, that's what we're seeing, and indeed, such variety of capital sources focusing on different niches in the litigation funding market leads to a great variety of funding structures and disputes. So Rob, what structures are most interesting to fund from your perspective?
Interesting question. I actually would phrase it the other way around. What structures are most in demand from claimants? Because at the end of the day, we're there to finance claimants. And I think we probably all know originally litigation financing is deemed, and I think we all agree, it's really, really important. It is this access to justice. And that has always been the David against Goliath situation. I'd like to think we're still there, although I think some funders are finding it quite difficult to fund the more modest-sized cases these days, which is frustrating, and we have to try and resolve that, I think. But I think we have grown up, as Adrian says. I think we are now appealing to the corporate world, and I think the last couple of years has obviously been dreadful for all of us, I suppose. But what is focused corporates on, particularly the CFOs, they are looking for liquidity, and I think litigation funding has become this alternative source of liquidity. And I was speaking a number of months ago to a FTSE 100 CFO, and they were saying, look, we'd never considered litigation financing before, but now he knew about it. He didn't want to, and his words, not mine, he didn't want to waste his cash spending it on litigation expenses. Hopefully he doesn't think he's going to waste our cash funding litigation expenses. But certainly, we are a source of liquidity to these guys, which is great. And I think that's really important. But then, one of the issues that we as funders have experienced over the 12 years or so that I've been involved in the business is lawyers and law firms in particular have always been a little cautious of litigation funders. But in this environment, I think lawyers suddenly realize that if their good clients don't pay them at the end of the month, then that can be a difficulty for even some of the larger law firms. So I think lawyers have realized that litigation funding can not only provide liquidity to their clients, but also provide some kind of liquidity to the law firms as well. So saying that, what are the products, I suppose, that we're looking to get involved in? Well, we do see portfolio financing. I think everyone talks about portfolio financing, and there are a number of clients out there who do have various disputes, and particularly we have found in the construction industry. But if a client has a number of disputes, we're very willing to fund all of those disputes together. There's some kind of cross-collateralization involved, which will reduce the exposure to us, reduce our risk. If our risk is reduced, then we're very happy to reduce the cost of capital even further to the claimants, and therefore it can be a lot more attractive than perhaps some people realize. So again, I think you may well be speaking about portfolio financing later this afternoon. The other area, which again gets quite a lot of coverage, is law firm financing. And that is where you can provide a facility to a law firm, and again, they can cross-collateralize cases that they think are suitable for funding. Now, my view is, I think that's a great opportunity. As far as the funder is concerned, the law firm effectively triages a matter. And one of the problems that we've always found is that there's a huge amount of redundancy in our business. And I think I speak for most funders. If we see 100 cases, we probably will only fund 2 or 3. So that's an awful lot of wasted effort. We all try and say no very quickly, but sometimes you have to do quite a little bit of digging before you can say no. So if you have a quality law firm carrying out this triage, initial triage, that can be very attractive for us. But then you have to realize, of course, this cannot be an exclusive arrangement. So the client, of course, is able to go to whichever funder they want. So there are some nuances involved, but I think there's a lot of talk about law firm financing. I personally think it's a fantastic opportunity if done properly, but some of the more high-profile relationships maybe haven't been as successful as they or perhaps the industry would like. We're also seeing group actions. I think we're very fortunate in the UK to have a structure that works and recognises the concept. Again, I think we'll speak more about that. So we see a lot of opportunity in group actions. And then finally, and I think Gary sort of mentioned this in his address this morning, the monetization of awards and enforcement of awards. These are, again, areas that litigation funders can get involved with and hopefully add some value.
Thank you. Yes, and I think these are all the sort of topics we're going to discuss later at different panels in more detail. Adrian, and do you think that, Rob mentioned portfolio financing, law firm financing. Do you think that this trend will continue in the future, in the next couple of years? What are sort of the challenges that you're seeing in this space?
Yeah, as to whether the trend will continue, yes, I think it will. I guess it's probably not for this panel to go into all the different species of possible portfolio structuring, except to say that you can kind of choose your poison. There's a whole kaleidoscope of different variations on it. Part of the reason for those products is it allows funders to deploy larger volumes of money more quickly, at least in theory, and also, at least in theory, it should make the process of obtaining funding from funders smoother for law firms. So the idea ultimately being that law firms are making more of the decisions. Law firms are a little bit closer to being masters of their own destiny, and they're paying less to the funder because the funder's got a greater spread of risk. So lawyers get cheaper pricing, which they can either use to increase their fees or, as we hope, pass on the benefit to their client. Funders get paid less. Is that a bad thing? No, that's a good thing. That's what happens in most financial industries. As the industry becomes more sophisticated, spreads compress, but professional funders deploy larger volumes of money at lower spreads. So I think on the whole that's a positive development. On the point of, are there any criticisms? I mean, yes, again, it depends on how the products are structured, but certainly in the early years, we and others, I'm sure, have seen these products not always structured in the most optimal way. And candidly, I wouldn't be at all surprised if a large proportion of those early portfolio facilities were never used or were hardly used at all, or were used no more than the law firm would have used single case financing. I think it's just a function of there were some early mistakes made, but also I think the law firms and the funders need to make sure they do a lot of the work up front to get a structure that ultimately is a benefit to their clients, but also isn't sort of as much of a hindrance as it is an enabler of financing.
Thank you. Question for Nick. So whenever we structure a new complex innovative funding, we always run it by QC. And the more innovative the funding is, the faster I call a QC. So you must have those really interesting structures landing onto your desk. So maybe if I can ask you to comment, what are you seeing again in the market? What sort of structures? Is it DBAs? Is it again, portfolio financing or some others?
Yes, I mean. First of all, thank you very much for the invitation. I'm sure I speak on behalf of us all. It's a pleasure to speak here this morning. I go back, to I started practice about 30 years ago. 1992, I was called to the bar. And when Adrian talks about the development of the hotel, restaurant analogy, he's absolutely right. I mean, we mustn't forget that it wasn't really until the 1999 Access to Justice Act that solicitors were able to do even conditional fee agreements, right? They had to charge, win or lose. We couldn't do contingency fee agreements at all. They were illegal. And so the last 20 years has been extraordinary, looked at from a sort of overhead view in terms of the legal development in this particular area. And certainly in the last 5 or 6 years, with these sort of guys have got, innovation is important, thinking out of the box is important. I see ever increasingly interesting and complex arrangements with law firms and litigation funders. And I'm really interested to see where it's all going to end up in due course. But in a direct answer to your question, DBAs are certainly much more of use now. There was a real nervousness about them early on. They are becoming more applicable in the right case, and they will work in the right case. I was involved, with some of the big portfolio funding arrangements with some of the leading funders. There, I agree with Adrian. They have their space and they have their place. But although the SRA has deregulated the market to a large extent from what it was, a decade ago, you still have the interests of the client paramount in the solicitor's mind when the solicitor comes to sign a client up to an innovative agreement. The solicitor he or she must be satisfied that it is actually in the client's interest. And I think that's probably where, there is a fine line to manage there. I spend a lot of my time dividing the work between, is it legally enforceable from a statutory regime point of view, to whether it's going to meet a knock on the door by the SRA, which is always important to law firms. It's absolutely paramount. And funders don't have that knock on the door, but law firms do. And so it's balancing those two things. And the SRA has not, certainly in my experience, landed in this space at all. Obviously, there's a bit of, in the low value stuff, the market with the old claims direct funders and that sort of fairly murky world didn't help. But we're a long, long way from that. And I think, responsible funders with responsible law firms will just rise above challenges of regulators, I think, in due course. So in answer to your question, it's become so much more complicated and complex, but all the more interesting for it.
Exactly. And how do you think, how does the way in which judiciary view litigation funding has developed in the past few years?
Well, again, I think there's been an extraordinary change. I mean, I remember the days, I remember the early days where judges would raise their eyebrows at the prospect of a funder being behind some litigation. It all started with sort of the ATE market, going back, to the beginning. Funding really started with low value personal type litigation. It wasn't seen as the sort of the pinnacle of legal excellence in terms of those who were deploying it. And gradually, as the market was, as regulation was reduced, and as I say, the legal market was deregulated to allow separate business relationships and so on, the funders got interested in London because of the conditional fee changes and the contingency fee changes, and all of a sudden, which is it is all of a sudden, in a relatively short period of time, there's been a burst of interest in funding, and a consequence, the courts have had to deal with this change of dynamic. And I'm very confident that the senior judiciary have landed in exactly the right place. They are obviously, it seems to me, from reading all of the judgments and being involved in the cases and so on, that funders are here to stay. They are a necessary ingredient to the future of big ticket litigation in this country. There's no doubt about that. And as Adrian said, you know, jurisdictions like the CAT, perhaps unintended consequence, but the consequence of that regime and the importance of the court's role, the tribunal's role in approving funding agreements has improved the prospect of the judiciary getting familiar with and understanding funding and living with it in harmony. In cases like Excelsior, you know, there are good cases where senior judges say, you know, funding is here, it's a critical ingredient to litigation. I guarantee 20 years ago that just would not have been on the senior courts judiciary's sort of headline at all. It would have been the contrary. So things are moving in the right direction. And I think the more, if I may say so, the more that the industry sort of comes together, developing, I think through associations like this and ILFA and so on, producing standardised, it's one of my things, standardised approaches to litigation funding to remove some of the legal arguments that can develop would be a benefit to the industry as a whole. You don't really want barristers like myself going along arguing about funding, actually. I don't mind it, I enjoy it, but you don't really want it. And I think ILFA certainly is behind a move to bring about that sort of change, which I think would be a good thing.
Thank you. And just to follow on this and ask Rob and Adrian, how do you compare the UK market to the other European markets in terms of sophistication and attractiveness and funding structures that you're seeing?
I think I touched on it a little bit. I think we're fortunate in the UK to have this understanding of group litigation. So the GLO, although it can be reasonably complicated, does work, and certainly we are seeing more cases coming to us that will be looking to go down the GLO route. Obviously, in Holland, last couple of years we have seen the WAMCA, and that's a new and I think very much welcome opportunity. So we'll see how that develops. But all these concepts take a bit of time to work through, and certainly, you know, I think it is a positive change. I think we've got the European directive at the end of this year, I believe, and it will be fascinating to see how that works. But a lot of, you know, Germany and France, they don't have the concept of class action. So I think the UK is well positioned to benefit from that, and obviously we would like to see it develop more.
Yeah, and I think I agree. You know, we're seeing an increasing number and size of claim seeking funding from across continental Europe. Yeah, Australia's always had an extremely well-developed litigation funding market. The US sort of less early than Australia and the UK, partly because lawyers were able to take contingent fees, so there was a less urgent need for it. But I think to some extent, London is the lab for these things, and that's for a couple of reasons. But I think one of the reasons we've always been a little bit more of a lab than, say, the US is because for very large ticket litigation, we're essentially unipolar. You know, if you've got London covered, you've probably got 90% of litigation above 10, 20 million pounds, which tends to be the bigger ticket stuff. So it's a little bit easier for an industry to develop there. And then we've got, you know, highly sophisticated insurance industry and highly sophisticated finance industry. So London sort of has just tended to be the lab for these things. But undoubtedly there are huge opportunities globally across Europe, some of which Bobby mentioned. I think there's even a panel later about some of the other opportunities across the continent. So yeah, look, I think interesting times, and it's certainly a core part of our business already.
And which sort of countries in Europe you would flag probably as most interesting for funders? You mentioned Holland and some others.
Certainly for us, yeah, the Netherlands is an extremely important market. We're doing cases in France. We're looking at a number of cases in Spain. Doing a couple of things in Italy. We've looked at a number of jurisdictions, and we've unlike some of our competitors, we've never advertised ourselves as sort of having any particular expertise across the continent. These things have just come to us, but there are other specialist funders who no doubt will have a vastly larger pipeline of continental European cases. So I think it's a very important growth market for us and for across the industry.
And I think Germany is also an area that we think is attractive. It's relatively lower cost litigation, but has been around for a while and works well. We found, although they don't have the class action concept.
And we're certainly seeing as well more interest from teams and law firms in Europe looking, when they have a good solid claim, looking into litigation funding as an option to bring this specific dispute forward, which is a great news for us sort of looking into those space. And I think the last point I wanted to cover is secondary market. So we're definitely seeing a lot more co-investment, syndication, co-funding as more and more sorts of capital enter the market, and also existing funders specialize in think niches or in this area. So Adrian, what do you think? What are still the obstacles to the secondary market, and how do you think this trend will develop in the future?
Yeah, I think the secondary market has almost always existed. I mean, since I entered the industry 6 years ago, it's just becoming more of a thing. It was always a bit, purely bilateral. Just find another funder, lay off a bit of risk if you've got too large an exposure on your book. I think the sort of increasing excitement around it is driven in large part by the volume of money coming into the market, and it's often money from large new entrants who haven't yet built up their expertise in the industry, and so want a lower risk way of sort of piggybacking on somebody else, but not by no means exclusively. What are some of the obstacles? I think one of the projects you've been running, the standardization of litigation funding agreements and the suite of funding documents, I think is extremely positive development and is a necessary condition to necessary but not sufficient condition to a flourishing secondary market for a couple of reasons. Just as a sort of general ethereal point, I know that when you went round the market and asked all the great and the good of the funding industry, will you join the project? At least one funder said to you, oh, no way, Elena, I'm not sharing the secret source of my documents. And I sort of think an industry where a major player can say that is an industry that needs to grow up a bit. If your documents are your secret source, your industry is a little bit in the Stone Age. And I think the attitude is shifting. I think also an objection with which I had a bit more sympathy was, but aren't we going to create standard documents, and the judiciary broadly in the UK at least sort of accepts funding, and in other jurisdictions, particularly some of the US states, it's not so excited about funding. Aren't we going to encourage all the cowboys to come in, use our standard docs, and that will upset everybody? So let's not go down that route of standardising documents. And I think that actually just gets it the wrong way around. I think by standardising the documents, sure, you may get some funder who doesn't know what it is doing, able now to use credible documents. But isn't that a better position if you go to court and you're in some sort of dispute over the funding arrangement, but the documents are well drafted, credible, and thought thoughtfully contributed to by key players. That must be a better position than, you know, a cowboy funder drafted it on the back of a piece of loo roll, and you get some bad decisions made. So I think standardized documents are very important. But one of the other drivers of secondary market funding, to which I think there is a solution, but we're probably a couple of years away from it, is there's not yet enough high quality product to satisfy all the money coming into the industry. So, you know, there can be a couple of functions of that. You know, one could be people start funding bad cases, which I don't think happens on the whole. I'm undoubtedly it happens once or twice. But another one can be spreads get compressed. We have seen a bit of that. And another one could be some of what we're seeing, which is the sophisticated players who've built up the IP and the staff are, you know, funding these big cases, and then they're selling pieces off to sort of less sophisticated players or newer players who are still developing their intellectual capital. But I think we may always have this problem of a lack of sort of, I don't know how you, like physical product, in the sense that there are only so many cases that can credibly be run every year. And one of the solutions to that, I mean, it reminds me a little bit of sort of the bond markets and the credit derivatives markets, you know, 30 years ago, where, you know, there simply weren't enough liquid bonds to satisfy the demands of investors. And so some of that was spread compression. One of the other solutions was the development of total return swaps and credit derivatives markets. And it seems to me there are good reasons why some similar products could develop in the litigation funding market, something along the lines of a total return swap transaction, a derivative transaction where, you know, Nick is funding a case and I want to take a piece of the risk of that funding opportunity off him, and instead of doing the usual participation or a syndication, I write him a derivative. You know, so far that's no real different from any secondary market transaction. Now, what about I do the same thing with Bobby? I've taken a total return swap from Nick, and I do a back-to-back total return swap with Bobby. Effectively, the risk has been passed from, or a portion of the risk has been passed from Nick's funding arrangement through to me via derivative, now through to Bobby via derivative. Neither Bobby nor I has any actual legal or beneficial interest in the claim. We've purely got a contractual monetary interest. That's exactly how the total return swaps and credit derivatives market develops when there was a squeeze on liquidity bonds. There's absolutely no reason why we couldn't develop the same product as between ourselves. I mean, there are some complications, but they're clearly surmountable. And by breaking the need actually to provide financing under a litigation funding agreement, no matter how standardized and lovely the docs may be, and by breaking that need for a link to the product, you unlock effectively an unlimited secondary market. And that may sound to some people like, oh my God, like, there's that evil investment banker talking about those toxic derivatives that used to structure. Actually, the benefit will be, we're already seeing huge innovation. It will unlock an enormous array of new products that will benefit lawyers and their clients by reducing price, but also allowing entirely new ways of hedging risk and of structuring risk.
Thank you.
I think that's right. And the key thing, I think, it will unlock a new universe of investor, because at the moment, the big problem with litigation financing is no one knows when the case is going to resolve. So there are a lot of funds out there and investors out there who don't have the capacity to invest in a product that may well go on for 3, 4, 5, 6 years. So if you can provide a genuine secondary market, I think that can bring a lot of benefits. It can bring effectively more efficient capital, which will be good for claimants, good for lawyers, and good for even good for funders. And then clearly, you know, if we had a fund that has maybe, call it, keep the numbers simple, £100 million fund with 25 cases in it, I'd rather have a £100 million fund with 50 cases, assuming Adrian does as good due diligence as ourselves, which obviously we'll have to discuss. but assuming the quality is the same, then that's good for everyone, good for our investors, good for the lawyers, and good for the claimants, I think.
And that's what we've seen in the leverage market. I guess it's a great way to de-risking investments. Nick, any comments on your side, maybe from regulatory perspective, judicial?
I think we have discussed this before. I mean, I think from the regulatory side, I think as long as the front end of the funding arrangement, so the client end, meets the requirements, of the broad requirements of the SRA code and so on, then what goes on behind the scenes, I think, speaking for myself, I think will be of less concern to the court. It's just ensuring that, as I said to you, funders have got one interest, law firms have got another. They want to fund their cases, but they have obligations to clients, and it's extremely important that whatever they do in terms of their funding arrangements, they meet the client's demands and needs. I can't see that this sort of innovative thinking will unravel that. Usually there's a pretty good answer to challenges of that kind, that most of these innovations are actually, in the broad sense, for the benefit of the clients. They ease the client's pressure, they enable access to justice, they make it less expensive, less capital demanding, and so on. So I don't think it's difficult to overcome, but always remember there is a client.
Yes, thank you. And I just wanted to sort of follow up on a pricing point that you mentioned. Do you think pricing now stabilized, or, because of all the new interest in the market, it will be spread a bit further? Where do you think this trend is going?
Bob, would you want to chip in? Or?
Yeah, well, look, I think pricing is pretty standard. I think, if you look at the raw statistics, a litigation funder typically is looking to win 2 out of 3, 7 out of 10, something of that sort of nature. And if you just work out the economics, if the case lasts for 2 years, the pricing is one thing. If it's 3 years, 4 years, 5 years, the pricing, we all have the same hurdles that we've got to overcome, and it is a very expensive business. Unfortunately, lawyers are expensive. So it is, you've got certain parameters that you have to work within. So I think we're all pretty much the same sort of figures.
Yeah, I think I agree on the whole with that. If you're looking at a business that's driven by a couple of metrics, amount of return, and whether you win or lose, and the amount of money you deploy. Yeah, if you adjust the price but keep the win rate the same, you either go bust or make loads of money, depending on which way you've adjusted. But I don't think I totally agree that the pricing is fixed, because I do think we're still seeing some pressure, some downward pressure on price. But I do agree, sort of more broadly, that it's not like we're seeing this crazy race to the bottom where people are funding things at levels where they're going to go bust. I think that what we're seeing, though, is a few years ago, the only pricing you would see was, I want 3, 4, or 5 times my capital, or even my committed capital in the good old days. That now, yes, you'll still see that, not so much of the committed capital, but you'll see I want 3, 4, 5x my drawn money, depending on when the case settles. But you're also seeing lawyers and increasingly their clients just being a bit more sophisticated, a bit pushier, as they should be, and saying, "Oh, listen, chum, this doesn't work for me in a low settlement scenario if I'm giving you 3, 4, 5 times your money." And because there are enough credible competitors willing to do more innovative things, you're seeing that kind of, the one restaurant in town with one thing on the menu change. And a simple example is a greater eagerness to see pricing based as a flat percentage of recoveries, particularly in things like group actions. And we can argue about what drives, but I suspect in large part it's because that's where the market landed in the US for contingent fee structures, was your lawyer will run your case and will take 30% of your damages, message ends. None of this stuff about multiples and minimum returns. And I think that's where the market's landed in the US, because it works well for clients. And that should be what we're driving at, is like, what is a convenient product that appropriately rewards funders, and then let them compete to sort of drive that price down to the sort of the correct marginal level. But ultimately it leaves enough for claimants to make the claim worth running and an economically sustainable position for them.
Yes, thank you. Yeah, we're definitely seeing both percentages and even high but flat rates for portfolio financing or law firm financing.
But I think, sorry, Elena, just one thing. I think the important thing is the more efficient you can get the capital, the funders, as Adrian says, the funder has got to get their return to make their business viable. But the more efficient that the capital, the investment is, the more chance you have of investing in a wider range of cases. And I think that's really important. And that's important for our industry to be able to cope with the more modest sized cases rather than just focusing on the larger cases.
I think also, it's quite interesting, the courts haven't really interrogated in any sort of meaningful sense the reasonableness of a funder's return. As I said earlier, the CAT has been extraordinarily helpful in the sense that the CAT will see what the return is, and there hasn't been a case yet where anybody's raised their eyebrows. There's an acceptance that there's a competitive market, and that supply and demand will set the reasonable return. It will be years down the line, a long tail of these cases, when uncollected damages are then fought over, and maybe arguments will develop then about the level of returns. But for my part, I think it will land on a supply and demand type argument. It will be, well, what was the alternative? And so, I don't think there'll be huge dispute about returns, properly commercially negotiated returns.
Thank you. Very good point. We have a few minutes left, so I just wanted to see if there are any questions from the audience. I think we have.
We've got one down here.
I think there is one question here. If we can bring the mic, please. Thank you.
It's getting there. It better be a good question.
It is, and it's for you. That makes it even better, I hope. You said it was difficult to finance modest cases. Could you elaborate on that? Why is it difficult? Is that because it's difficult to get the right returns? Is it because cost of due diligence is too high compared to the case size? What is it that makes it difficult?
I think it's all of that. I think what we work on as a rough rule of thumb, and again, I think most funders are pretty much the same, you need a proportionality. The damage has got to be a certain multiple of the costs. Now, again, I think I talk for the industry, it's not good for a funder to fund a case where the claimant isn't going to get at least 50% of the damages. Now, we'd like to think more, but on the modest-sized cases, it all depends. I'd love to shift the blame totally onto the lawyers, but how much is it going to cost to run a case in the High Court? If you said £250,000, maybe, you just can't economically fund a case that's not several £1 million. It's just very, very difficult. So the way you get around that, I suppose, is starting to do portfolios and try and be a little bit more innovative. But it's wrong. If you've got a claim for £1 million, that is a significant amount of money. You should be able to get this access to justice. But it's just difficult from an economic point of view. And look, also, we're a small company. We've got 50-odd people in our company. When you do the due diligence, there's only a certain amount of bandwidth that we have. And doing the due diligence on a modest-sized case is pretty much the same as doing the due diligence for a larger case. So it's, you know, I hate saying that. When we started, we were funding very, very modest cases, but we had to move up the ladder, so to speak.
Can I just chip in there as well? I think in the future, so looking ahead, the next decade, I think in those modest cases, they'll be easier to fund. I think the litigation costs arena will change. My own prediction is that there will be a fixed cost structure in what we call modest value claims, and we won't have, I don't think, the same level of recoverable cost that currently prevails, and so there'll be a more modest collection or obligation to pay costs, which will help ease and facilitate funding. That's my prediction.
I mean, I would add one other element that may contribute to a solution, which is, I think not that there aren't enough good data available. Because, like, fundamentally, if I could say, I think I can say anecdotally that small cases tend to settle more quickly, more frequently than larger cases. So right there, I've probably got a bias towards a slightly higher win rate than funding the gut buster, you know, multi-hundreds of millions or billion pound cases. So maybe that's part of the solution, but you'd need a lot of really good granular data to be able to start building a model on more of a data-driven, data-driven model. Look at, for example, investment banking. You can structure deals based on credit card loans. Who the hell's going to go and do due diligence on like 10,000 individual credit card loans? You just don't do it. It becomes a data-driven product, and that's the only way that's. If they were running those like as they run, big residential real estate, commercial real estate lending deals, it would never work. And here's a call to like the industry. One of the things I think our industry should be bigger on is transparency. I think we should be sharing data anonymously, because no one wants to sort of share all their super duper secret source. But I don't think there should be any fear about being transparent, albeit on a collective basis, so that you can't sort of differentiate which case belongs to which funder. And if we started doing that in the small case funding market and maybe the mid-sized funding market, the large one, we would start to develop data. I think that would be extremely healthy for the industry. I think it would be really healthy for investors. I think it would be healthy for lawyers. And I don't think we should be afraid of it. I think that sort of also ties into the secondary market and development of standard documents. I think we are growing up, and I think we should continue to grow up, and part of that is greater transparency and data sharing.
Thank you, Adrian. I think it's really, really important point. So, okay, we have a couple more questions. Maybe just one or two, just to...
This is just a comment on this Uyghur Wheelinga Omni Bridgeway. On the last question for more modest claims, we purchased about 5 years ago a litigation funder in Germany called Roland Prozessfinanz, and the majority of their claims were actually below $1 million. So they've been funding for about 10, 12 years cases around 200, 400, 500,000 euros. And they were actually reasonably profitable, and it's quite an interesting business model. But it ties into the cost levels of German litigation, because all of these cases were principally charged on the standard fees, a fixed fee model of the German, let's say, more differently organized lawyers. So it can very well work. However, we've been moving away from that and changed our strategy into doing more high-value claims. And that goes back to the due diligence cost that we have internally. Judging a case of 400,000 may well be exactly the same amount of work as judging a case of 400 million. The legal questions that you may have or the factual issues may actually also require a lot of work, and hence a lot of work from the people that you employ, and that can be, let's say, cost ineffective. So that is driving that move away towards higher value cases as well. I certainly hope that Nick's right, that we will see a shift in the fee models to have that access of justice. I think that's really needed. And I'm sort of sorry myself to see that we've moved away from these smaller cases, because there have been many cases that really deserved funding because, you know, someone's limb, the wrong limb has been amputated or whatever. All these kind of, you know, very sorry cases that you could help your clients with.
Just last question, thank you.
Hi. Adrian, you mentioned insurance a couple of times. Litigation insurance is getting more sophisticated, particularly portfolio solutions for funders. How do you see that contributing to the downward effect on pricing and also particularly your ideas on the secondary market?
I mean, I think insurers have a gigantic advantage over funders in that they have vastly cheaper capital, and that allows them to offer some really interesting products that work, you know, either in competition with funders or in conjunction with funders. I think they, you know, we and I know many of our competitors have used insurance in kind of funky, very helpful ways. And I think the insurance market, side by side with the litigation funding market, is seeing a lot more entrepreneurialism than probably, you know, 6-7 years ago. I think it's part of the same trend, and I think the outcome will also be the same, which will be cheapening of the overall package of financing and ATE insurance, cheapening of the capital, and ultimately it should all be of benefit to claimants and their lawyers.
Thank you. I think we are out of time, so I'd like to wrap up. Please join me in thanking our panel today. If you have any questions, please do feel free to reach out to our panelists or to myself. And I would like to invite Neil Shrimpton, my litigation partner, to moderate the next panel on class actions. Thank you.